you founded and sold Aconex to Oracle for $1.2 billion. Is that the biggest acquisition in the space still?
In the space it is. It was at the time it was the biggest tech acquisition in Australian history. I think Oracle got us at exactly the right time for a range of reasons. I think it's fair to say that if we had to continue down the journey that we were heading down, the acquisition even 3 or 4 years later would have been significantly higher than what it was. Great software companies, even outside construction, don't have to be sexy, right? They don't have to solve sexy problems. And inside construction, certainly, for the most part, they aren't sexy.
Hey everyone, and welcome to the Bricks and Bytes podcast, where we dive into construction and AEC technology. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology, and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode. In construction, precision matters. Every budget line, every schedule, every document. But too often, project data is scattered across tools and departments, creating risky silos. That's where Archdesk comes in. Archdesk is the all-in-one construction management platform designed to connect your entire project operation, from opportunity through to tender, all the way to handover. With real-time dashboards, cost control, scheduling, procurement, and document management in one place, Archdesk gives you complete visibility and control. Trusted by contractors, subcontractors, and asset owners worldwide, Archdesk has powered landmark projects from shopping centers to Europe's tallest buildings. If you're ready to reduce risk, protect your margins, and deliver projects with confidence, discover Archdesk today and visit archdesk.com, that's ARCH desk.com, and see how leading firms are building smarter with Archdesk. Major construction projects are complex, and delivery leaders know that things rarely go to plan. The problem is that most teams don't see what's slipping or why until it's too late. The best construction leaders know that in order to deliver on schedule, everyone needs to be planning together, committing to targets, and tracking performance every day. By bringing look-aheads, weekly work plans, visual staging diagrams, and daily activity briefings into one multiplayer platform, Aphex gives the world's leading projects a single place to plan and coordinate their work. Join the largest contractors across Europe, the UK, Asia, Australia, and New Zealand. Learn more at aphex.co. That's aphex.co.
All right, Rob. Well, we were just chatting off air about many things, but didn't quite get to what we're going to get into today. So I said we should hit record before we start talking too much and give away too much of the story. So, Rob, thanks for joining. I think most of the people that listen to Bricks and Bytes will probably know who you are. You founded and sold Aconex to Oracle for $1.2 billion. Is that the biggest acquisition in the space still? Yeah, you still wear that badge.
In the space it is. It was at the time it was the biggest tech acquisition in Australian history. There's been bigger tech companies like Atlassian and Canva are bigger companies, but they haven't been acquired, right? So it was at the time the biggest acquisition. There's been a couple bigger since, but at the and as I understand it, it's still the biggest acquisition in the contact space globally.
Yeah, nice. You still had the medal win, which is great. I will get in. I want to ask some questions around that and whether you think that will be overtaken anytime soon, and maybe why it hasn't been overtaken in recent history. But we can get to there. But just so people are aware, what we're going to discuss today is a little bit about Aconex, your origin, product, the go-to-market. You scaled, you went through IPO, and then you had the big exit. Your latest venture, Glitch Capital, and how you go about investing and then advising founders to build great companies, and then just give your thoughts on construction technology generally across the board. So before we get there, what was it like day one after signing that agreement that you're going to be selling Aconex, your baby,
Mm.
to
Yeah.
Oracle?
It was actually it was an incredibly emotional day. I've got to say, and there were elements of, there were positive things to it, of course, but there was also a sense of sadness, a sense of the end of something. And not that the product's gone away and Aconex still exists and it's doing actually quite well within Oracle, but the team that built it and how we went about it, it was just the end of that journey that we had. I know. So, I mean, the short bit of it too, by the way, is like Lee and I, founders, and we weren't looking to sell at all. And it just so happened because we were public, we were being short sold at the time by the short sellers, which we'll maybe get into that as another story. We were a target for an acquisition that was unsolicited, but nonetheless it came in. And you can say, people say, "Oh, I won't sell at any price," but when you're a public company, you've got a responsibility to your shareholders. And so when the price gets to a certain level, you've got to take it to your shareholders and say, "What do you think?" And when you're a public company, everyone else is not quite as invested in the business as you are, right? So they're looking at it through a very hard-nosed financial lens, and a lot of them are like, "Yeah, that sounds like a good deal." So yeah, and we kind of lost that. That's the realization actually we had, was when while you've started this business and you still major shareholders, you're not majority anymore. And when you take it to shareholders, you've kind of lost control at that point. It's into the hands of the group. But that day was actually really emotional. I remember we knew that it was coming. We'd done a whole bunch of DD kind of leading up, and then it got announced to the market, which had to be very hush hush. Like nobody else could know because you're public. You had to keep it very, very quiet. And I remember the morning that it was going to be announced on the ASX, the Australian stock market. I remember being at work early, waiting for the announcement to go out before the market opened, and I just went out to get a coffee by myself and then came back into the office. And I was kind of coming back in. The office was still kind of mostly empty, and in the foyer, and my phone went bing, and up came the message that the announcement had gone live on the ASX.
Wow.
And I remember just breaking down and crying in that moment. Just kind of everything just kind of came out. It was both, and I said this to the team later, like how I felt. I felt both immensely, like I felt sad, but I felt immensely proud at the same time. It was this proud and sad, proud that we'd kind of been able to build something that was, it was not that was the end goal, but it was such a validation of what we were doing, I think. And then the sadness that, it wasn't going to be the same anymore. It was going to change.
Yeah, and that was that. That's actually giving me goosebumps listening to that. I feel like I've experienced a piece of history being there with you when that phone pings. Does anyone else like in the office, are they aware that this has happened? Maybe one or two others, but is like everyone there, and then like you went out for a coffee, then you come back and suddenly you're like, "Oh, what happened?"
Yeah, like most of my direct team didn't know. There was a very select set of people that we had to bring inside the tent to help kind of facilitate the DD that they were doing kind of ahead of that announcement. And so, there were, probably 40 people that knew across the business, but my direct team broadly didn't know. So, that moment was like, like a, oh, wow moment when people kind of, the realization hit and gravity hit.
Yeah, nice. Okay. Yeah, we can dive into a little bit more about like what made it. Yeah, like perhaps a little bit about the journey from where you went, like started all the way through to the IPO and then through to that exit. But why do you think, like construction technology? Why do you think we haven't seen this kind of like definitely in more recent times, like these kind of larger acquisitions playing out in the space, perhaps that we might other see in other industries?
I mean, there's been some big ones. I mean, you've got some roll ups. I mean, there was Plan Grid by Autodesk and then PayApps more recently by Autodesk, and they were both big acquisitions, both sub $1 billion, but still in the hundreds of millions. And they're by any measure a successful business, right? But it's true that we haven't had any kind of like multi-billion-dollar acquisitions. And by the way, I think timing plays into this too. I think I think Oracle got us at exactly the right time for a range of reasons. Partly, and we can maybe talk about the short selling in a second, and that suppressed our price in the market. But also in 2017-18 when this happened, since then, kind of valuations have lifted. So, you never know what can happen, right? Like, but you might have gone out of business altogether. But I think it's fair to say that if we had to continue down the journey that we were heading down, the acquisition, even 3 or 4 years later, would have been significantly higher than what it was. Which is probably, kudos to Oracle, right? They picked the right moment. They acted decisively, and I think I got it for in retrospect, a pretty good valuation. Where were we going with this, by the way? I forgot the original question.
I was just about what, like more, I suppose in recent times, you did mention a few pay apps.
That's why we haven't seen any other big one.
Yeah.
And I mean, we've seen, Procore's gone public, right? So they haven't been acquired, but they're certainly a major player in this space that have just gone through the going public route, and they're arguably at a point now where they're too big for anyone in the construction space to acquire. Even the guys that are kind of big kind of might find that hard to swallow. So I think it's kind of in this space. I think there's going to be roll up and there's going to be consolidation, but it's picking the right moment to do that. And I think once it starts getting into the billions, the transactions are hard. I think it's kind of more like the hundreds of millions is when people are going to be starting to pick off these things and consolidate them up.
Interesting. Yeah, I think on the IPO front, maybe there's one that's about to happen. I think there was a company in Inframarket in India who have filed for IPO, which and they're going through the process right now. So that'll be the next one. But I think the latest biggest one was Procore. So we shall see. Hopefully it increases. What do you do now? How is life been since, and like what's your current doings?
Life since has been good. I've got to say though that the transition out was maybe I'll talk about that for just a second, was a tough one. So I stayed on for a little while, partly because I had to, and partly because I wanted to make sure the transition was done smoothly and customers were looked after and staff were looked after and all the rest. And for the most part, that was something I think was successful. But I had to give a year's notice at the end. And I stayed 2.5 years, but before the 2.5 years, I had to give a year's notice, and which is a long time, but nonetheless, I gave notice at July 2019, thinking that would be the right time, fast forwarding a year, not knowing that COVID was coming down the pipeline. So when I actually did finish up in July 2020, after being at home for 4 months, it was quite a surreal and sad moment, actually. So my final day was Friday night Zoom drinks on a call like this.
No.
Where, sitting around having a whiskey with people on the call. And
because
I was imagining, by the way, back in 2019, I was imagining my last month to be a month of long lunches and karaoke in the last night, and walking out the door with my box on my arm and saying, "See you guys." But then there was this Zoom call, and then sitting at this desk that I've been sitting at for months, probably my underwear or something, I don't know. And then hanging up the Zoom call, and then everyone's gone, and then it was just that was such a sad kind of, I don't know, down moment for me. That final moment. We did, by the way, just a couple of weeks ago, have an Aconex reunion, a 7-year itch, we called it, 7 years after the acquisition, where we did it in Melbourne. Maybe we'll do it in some other cities around, but we had a bunch of people come to Melbourne. There were like 250 people turn up at this reunion at this pub, and it was unexpectedly emotional for me. Well, I always thought it would be great, but it was unexpectedly deeply emotional for me. And I think part of it, in retrospect, was because I never got to have that final kind of farewell party or farewell celebration. It was kind of bringing together all these familiar faces that are more than familiar faces. Actually, they're people that you've been in the trenches with. They're people that you've gone through this journey with. That I think we had such a good culture. By the way, it was, and it was all to do with the people that were there. And I think the thing that characterized everyone, if you had to distill it down, it would be that we all gave a shit. We all really cared about each other and the customer, and we just really were in it. Like, we're in it. And I think kind of getting back together with those people again was pretty special. So that was kind of like the transition out was with the downer. More recently, I've had something to kind of make that good. But then, so since then, I've been investing in early stage tech, and also helping out kind of some of those. So you can't help out everyone that you invest in. So you kind of have to be a little bit selective. But I am, through my kind of family office, have been kind of investing in, early stage B2B SaaS companies, kind of turning over, kind of $1 to $10 million, which coincidentally is kind of what Glitch is now. Not coincidentally, is now what Glitch is kind of investing into. But, that kind of early stage, but not kind of really early, but early stage. And then selecting a few of those that I kind of want to get involved with, either on a board level or more likely to be kind of more mentoring or kind of helping them out in a more informal way, which is I prefer personally. And that's been actually really really great for me. I was wondering whether that would be something that would turn me on kind of intellectually, whether, when you've grown a business, you're so used to doing things and being in the business and helping execute. And then when you're outside and investing and helping it, like you're kind of more like a cheerleader rather than a doer. And I was wondering whether that would give me enough joy. But it actually does. I enjoy it way more than I thought I would. And that's been something that the journey has been with me on. So the last 5 years I've been doing that. And then for a range of reasons, so Lee was also doing kind of similar kind of direct investing in a similar space. We were kind of investing in 90% the same stuff, but not really sharing our resource. We both had people helping us out with investment analysts and all the rest. And we, we had that, plus we had a few other people turn up that had good exits, like from Pay Apps and Jeff Tarrant from Pay Apps and Sam Cronenberg from a Cloud Guru that had a good exit too. And he was like, I want to be active, but I don't want to set up my whole family office. What do I do? And so we it was natural for a group of us to come together and pool our resources from an investment point of view. And then we brought in other LPs who invested into the fund, who were, for the most part, not exclusively, but for the most part, they were either past founders or kind of existing founder operators that are in there now. So we've got this really great kind of cohort of people that have kind of founded this, kind of put money in this fund, and we then get to invest in these great companies. But then we also get to, back them up with that kind of same kind of thing that I was doing before, where you get involved in a few things. But when it's only one of you, you've only got so much bandwidth and you've only got your skill set. Whereas now we've got this bench of amazing people that we can kind of touch and get involved with every business that we invest in, for one. But also we've got a kind of a broader set of skills. So whether it's, whether they want to talk to someone about go to market or around product or around, people management or leadership or whatever it might be, there's going to be someone in the group that's going to have a really strong kind of bent towards that. And that's what Glitch is all about. And the reason why it's called Glitch is when you're founding a company and you're growing it, like things go wrong, like you screw up, things fuck up. And it's not that avoiding, like they're inevitable. It's more about how you deal with it that matters. And so we kind of pride ourselves on kind of putting money in, but then helping these people navigate the inevitable screw ups that happen along the way. Because as you grow a business and you get bigger and bigger, and there are kind of vanishingly few people that have actually been in your shoes. And so, often we, I catch up with some of these guys, like, and it's sometimes very execution level stuff, like how do I think about go-to-market strategy, or what's pricing, or you sometimes talk about that, but often founders want to catch up with someone who's been in their shoes and just almost like vent and just talk about how tough things are, and have someone on the other side who goes, yeah, I get it, and it is bloody hard, and yes, it is hard, and then they just go, oh, thank God it's not just me, and then they go away feeling, I think, like a pressure relief valve has been let loose, and they're kind of ready to kind of go for the next the next round, ding, ding, round 3.
Mm-hmm.
And yeah, I really enjoy that.
So part-time psychotherapist, part-time investor.
Yeah, totally. So I've said this to a bunch of guys. I've said it's like 10%, business and 90% psychology.
Yeah. Nice. Well, was there some things talking about Aconex? Like, why did it grow so well? Like, were there some key things that, like, I don't know, 1, 2, 3, 4, 5 things that you did that was like that were that maybe were small or big, but just had such big impact on like the growth and
Yeah.
size of the business?
It's a funny question. People have asked that, and we've asked ourselves over the years. And you try and unpick it and go, what? And by the way, I think you got to be careful in all this stuff. There's this kind of survivor bias that you can sometimes have, where you kind of look at the ones that have succeeded and try and go, oh, they're successful because of X, Y, and Z. But a lot of it comes down to timing and luck too, right? Like, I'm not going to sit here and say it was all because we were so shit hot and we nailed it. Like, you've got to be at the right time. And I think timing is actually, from some studies I've kind of read, is probably one of the most impactful things that determines whether you're going to succeed or not. Is because if you're too early, like you struggle to kind of get traction. If you're too late, the wave's already gone past you. It's kind of getting that sweet Goldilocks spot of timing. You've got to have a bit of luck, like when we almost had a near-death experience when we did a capital raise just before the GFC happened. And if that had happened, like if the capital raise had been 4 weeks later, I don't think it would have closed, and we would not be around. Like, there's got to be, there's luck involved in some of that stuff.
Well,
but
that
then
was like 2008, right?
okay, yeah, exactly. But then there's other things, and we try to kind of think, what's the kind of secret sauce? And it was actually something we also put some thought into when Oracle was happening, to try and get them to understand what the secret sauce was. Partly it was the culture of people giving a shit and caring about each other, and having this kind of attitude of, and I often talked about this is like, forget the culture for a second, like really great entrepreneurs have like a duality and a kind of contradiction inside themselves. A little bit like great entrepreneurs have got to be super confident, almost to the point of having an ego. But at the same time, they've got to be humble and shit scared they're going to lose, right? Like, and if they have both sides of that coin simultaneously happening, that's actually the people that navigate this really well. They've got the confidence to try and to keep going, but also the humility to know that they don't know it all, and looking for answers and asking for help. And so we had inside the organization a bit like that. We talked, some of our values, by the way, were question what's accepted and get on with it, right? Which there were two different things that contradict each other, because you can question what's accepted is kind of like always like, why are we doing it this way? How can we do it better? But you can't constantly be going, how do we do it better? How do we do it better? Sometimes you just got to get on with it, right? So inside we had, I think, a really good mix of people who were pragmatic enough to get on with it, but had kind of a level of perfectionism that really mattered. So there was the people that really mattered, and I think we were super lucky with all the people we hired. Timing was right. I think we've spoken about timing. We had a few things that happened around, I think, pricing and how we priced, which were kind of really revolutionary at the time, but they ended up having some unintended but really amazing consequences around network effects. And so we were a business that sold to project teams, right? So while one of the people on a project normally paid for the license for Aconex, it was then the whole project team that used it. And there were kind of typically between 100 and 200 companies in a project that would use our software. And so the network effect of coming together on a project, and if everyone was familiar with the software and they'd been using it before, and then it was easy for it to kind of go on to the next project. And so a little bit like the analogy of back in the day of faxes or telephones. Like, if you're the only person with a telephone, then it's kind of a useless tool. And if you've got a telephone and your friend's got a telephone, that's interesting. But if your whole friendship group has telephones, then that's really powerful, right? Same kind of network effect. And so what happened was, I'll talk through the kind of the pricing model we had and what we ended up with and how that network effect drove. We were originally thinking we were going to do per user and then transaction fees. That was the typical kind of pricing model back then. Like user-based pricing, $10 a user a month, and then charging for, storage and charging like a little clip on the ticket on certain transactions and all this kind of transaction-based stuff. And it kind of made sense. The problem with that when we went to customers is when it's all very like transactional, it's hard to understand what it's going to cost for one. You have to, make a bunch of estimates. Like, can you remember, 10 years ago, what mobile phone plans used to be? Like, you turn up now and you buy a plan for, generally you buy it for like, £50 or £60 or whatever you pay for your plan.
Mm-hmm.
And it's just
That way.
everything's in it. Whereas back then it was like you bought so many minutes of this and so many SMSs and, so many megabytes of download. And you had to have like a mathematics degree just to kind of understand what it was going to maybe cost you.
Yeah, I had many
we-
strong conversations with my mum about going over my texts and minutes allowance when she used to pay
Yeah.
my phone bill when I was younger. Yeah.
Yeah. Yeah. So we went with this pricing model of transaction-based stuff. And our first few customers, actually, God bless them, said, I don't understand how much this is going to cost me, but I need to understand, because they were saying, I've got a fixed price to deliver this project and I need to understand how much this is going to cost. Just tell me how much it's going to cost. And so what we then did was we went off and did some modeling for projects of certain sizes, like $10 million project, $50 million project, $100 million project. We kind of made assumptions around how many users they'd have and how many megabytes of storage they consume and how much training they'd need. And we just made all these assumptions and then kind of did that for different sizes. And then it ended up not in a linear line, but a bit more of a curve, which kind of made sense too, right? Like as you doubled the construction value, the price went up, but it didn't go up double, right? It's because you had more drawings and you had more users, but you didn't have double the number of drawings. You didn't have double the number of users. It went up, but it kind of tailed away. And that also kind of fed into the idea that the more value you commit, the bigger the discount. There was a whole bunch of reasons why it made sense. And you could also articulate it really clearly. Like you go to them and say, for this project, it's going to cost you X per month. And in that, everything's included. We had this all-you-can-eat model, right? Like as many documents as you want to upload, which we were scared about that at first because we thought, geez, if people upload heaps, it's going to cost us in storage, because back then storage was really expensive, way more expensive than now. And what if they use it heaps? But that's actually, and I talk to people about this all the time. Like if people use your software a lot, that's not a problem. In fact, that's a great thing. And their adoption of it and their use of it, if you look at the cost of that your cogs of delivering the software are actually like really, really low. Like the big costs are in building the software, selling it, and all the kind of back officey stuff. The cost of deploying to another user is basically zero. The cost of storing another document is incremental, but not really that big in the scheme of things. So you're much better off kind of sucking it up on a project that uses you a lot, because if they're using you, they like it and they're getting good value out of it, and they're going to come back and use you again, and the network effect's going to spread. So there were two things that came out of it. One was the adoption was really great. People then started putting up every drawing. They started giving every user an account rather than going on a project going, oh, there's 100 of us, but maybe we're only going to give 20 of you a license because the other 80 of you don't really use it every day. So you can share an account, and that would have ended up with a suboptimal kind of outcome. So people put up all the documents. They started sending all the RFIs they wanted. They didn't think about transactions. They just went and used it, and everyone had an account. And so this network effect at the end of a project was really, really strong. So end of a project happens, you don't have that exact same project team move on to the next project. They kind of all splinter and go off and seed another 5 projects because they all go off and do different things. And what they did then was everyone went with this knowledge of this tool that they'd used, and then they were much more likely to use it on the next tool. So the unexpected consequence of our pricing model was that it had a really, really strong network effect, which kind of supercharged our growth. Yeah. I'd like to say that we intended to happen, but that was kind of the happy consequence that happened at the end of it. And now that's kind of, that was unheard of as a pricing model back then, but now that's kind of almost standard, especially in this space, about, construction value as a way of pricing stuff.
Yeah. Do you think that it's the best? Maybe best is strong, but maybe the most optimal way of that like startups should base their pricing models in this space?
Yeah.
Because I think that the one that people hear most of is Procore based on revenue of company, which even I think Tui, the CEO or ex CEO now, is like it's the thing he gets the most stick for from his customers, and everyone's always like, "Oh, it's
Mm.
wrong. They shouldn't do that." Um, so, and I think there's a
But that's
lot
the
of
same
like,
thing as project. But that's the same thing. That's kind of like the extension of our model, right? Like, which, by the way, revenue of company is the same. Like, if you're a builder, then your project book is your revenue.
mm,
Yeah. So what?
hmm
So you could come on and you could buy one project for 100 million, or you could just say, "Give me a price for all of my book of projects." So my revenue of my company is to bill, and then you could feed that in. And that was also the other thing that was great about that model is because the bigger the value, the kind of the it kind of gave you a bit of a discount. As you committed more and more volume, you got a bigger and bigger discount. So it made a whole bunch of sense. And
mm,
so the way that Procore price came from us, like they copied that, which that's fine. Like they can copy that. I've got no issue
yeah,
with that at all. But and people sometimes go, we shouldn't price that way. But then, okay, what's the alternative? The alternative is you go back to a user-based licensing model and a transaction kind of based licensing model. And we did not at the very start, but towards the ends, especially when we were into the US market, there were US companies that insisted on, I want to pay per user. So we did have this ability for companies to buy per user. And we went to them and said, okay, you can do it. But they invariably switched to the unlimited model because it was cheaper.
yeah.
Because you didn't have to track your licenses, you didn't have to worry about it, and they would always underestimate how many seats they needed anyway. So the unlimited kind of all you can eat based on construction value or revenue ended up being for most people the best way of pricing. They ended up getting it for cheaper than any other way.
So you think that it's still something that people, if they can, should explore?
Well, I don't think I'll give a blanket statement that for every Comtech business that's how they should price.
Mm,
But I think when you think about pricing, I think the thing you've got to try and do is come up with a way of pricing that you get the more value they get out of you, the more you get as revenue, because I think that's a fair trade-off. But don't put your pricing mechanism as something that kind of limits or throttles their use of it too much. Because the reason why that is, like, if the other day I was even these things where you buy credits for, whether it's downloading images or using an AI tool to generate something. When it's a credit based kind of model, you're thinking, okay, maybe I'm not going to generate that video that I want to generate because it's going to consume
yeah.
some credits. So you kind of,
Uh-huh.
and so you don't quite get the value out of it. Whereas if you just paid, 100 quid a month and you just got to do stuff, you just go off and you generate all you needed. And you're much more likely to renew next time because you got some huge value out of it. Whereas if you limit your use of it, your value goes down as a user. And I think it's such a kind of counterintuitive but powerful thing that people screw up in pricing so much is the pricing mechanism they have works against them in terms of expansion of the customer, but also in terms of retention of the customer.
Mm, mm, mm. Yeah, I think value is an important point because you don't want people like you're just adding friction, right? If people are not, they're not, don't feel like they can use the platform to its full extent because they're restricted by money, effectively, which is a
Yeah.
subscription. Then they're not going to use it, and it just puts barriers in the way to
Yeah.
the usefulness of the product and even like how much people would love using it.
Yeah. Even tiered pricing too, by the way. This is one that you can get right and you can most people get wrong. Tiered pricing is where you generally kind of, as you go up in the tiers, you get more capability built in. And the best kind of tiering is where you want to go up to the next tier because there's something in there that's you don't need, but you'd like to have, and it kind of enables you to kind of take the next natural step. Whereas what most people do is they go, I'm going to have it, bronze, silver, gold, whatever. And then they basically just start stripping out functionality out of capacity out of the various tiers to kind of have the bronze, which is kind of like your crappy version that doesn't do a whole lot. And then people who then use that bronze version, effectively what they're getting is they're getting a crappy version of your product. They're getting a product that doesn't do a bunch of the stuff they want to do. Whereas what you're better off doing, rather than stripping out functionality, my view is you're better off giving everyone all the capacity they need, but then having a natural limit that importantly stops them from over. It's kind of almost like a usage limit, right? But you don't want to stop people using it, a bit like these credits, right? You don't want to have them come on and go, oh shit, I can't upload another document because I've hit my limit. The best kind of tiering is where they naturally, inside the business that they've got, for the price tier they're at, they kind of are within the constraints. Because I think what you're trying to avoid is and people think about this, they go, I don't want someone buying my $10 a month version and being like a multinational billion-dollar company and getting it for $10 a month, right? That's their fear. So if you have a tiering that kind of naturally kind of works through that without people having to stop what they're doing, that's when you've nailed your pricing model.
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
Nice. Well, what was Aconex's like a go-to-market? I suppose like maybe you can talk about it in early days up until when you had product market fit, and then how it sort of like developed as the product started to get into the hands of more users. Were there any like stuff that you did like, oh shit, that didn't work very well, and you had to pivot and change? Any lessons?
It was so we were a direct kind of sales force. We weren't product led growth. Well, we weren't a model where people signed up by credit card online. We were kind of, and there are a bunch of reasons for that. I mean, partly in early days, you actually want to talk to your customers a lot because you're trying to figure out, positioning, and you're trying to figure out if you've got the right thing. And so that conversation you got with customers is really, really valuable. But also what we were doing, especially when we went to this kind of pricing model of all you could eat, it wasn't like, $100 a month per user. It was for the whole project team. It was, a few $1,000s a month. It was, typically our depends whether you talk about TCV or ACV, but our ACV was probably 60 grand a year. And if you're signing up for a 3-year deal, that's kind of like 180, that kind of number, right? People aren't going to put a 60 grand on their credit card, right? So there's a point in a sales cycle where you get above a certain price point that people want to speak to a sales guy, and they want to, and there's a point beyond that where they actually want to start negotiating terms and having, certain terms in the contract. And so we were always, right from day one, I think, beyond the point where an online, cheap and cheerful version was possible. And you kind of team that up with, we wanted to talk to the customers anyway. So we were always a direct sales force. We did try over the years, trying other models with resellers and partners. And I would say, I wouldn't blanket say that didn't work, but in most of our geographies, that didn't work great. So let's talk about resellers for a second. So the typical reseller that you had in the past before SaaS came along was people would sell software for $1 million, and then they'd come along and sell services and customization on top of that for another $1 million, right? That's how resellers made their money, not in selling the software, but in selling on, the value-added services. That's why they were called VARs, value-added resellers. But because we're a SaaS business that had no customization, like it was just, you configured it for their use and off they went. Like, and the configuration took, in some cases, minutes, and then, it didn't take long, right? So there wasn't really much in it for the resellers apart from like a commission, and they weren't really interested in just getting a 10 or 15% commission on the SaaS deal, especially when it's a trail and they're getting their commission in the trail. They didn't really like that. So value-added resellers, for the most part, didn't work, and that's probably globally. But the thing that did work was partners, especially in China, especially in the Middle East, where relationships are kind of important, more important. Where, for example, in the US or in Australia, you can do cold calls, right? Like, cold calls are hard. I'm not going to make them sound like they're easy, but you can call someone up, you can kind of get a meeting, you can go through the process of showing them, you understand their problem and here's how we're going to help you solve it. And you can go through that process. Whereas in places like China, you almost can't get through that first door unless you've got an introduction. And so that was important in the Middle East, in China, in Japan. So the partner model worked well in certain circumstances. We never got to the point of having a credit card gateway online buy stuff model. I wonder, like, I think we could have, and that's, by the way, one of the reasons why we stayed in the kind of the larger project space. It wasn't that the product wasn't able to be used by smaller projects. It's just that our go-to-market didn't make economic sense for very, very small projects. Because when you've got to pay salespeople and commission, they're not going to go after a $10 a month kind of customer, and you can't afford to pay them a commission on it anyway.
All right. Yeah, Rob, so you mentioned direct sales, resellers didn't work well, partners were good in like cultures where introductions were necessary, and you didn't quite do the credit card thing. Can you just give us an idea, when was this, like, when were the sales accelerating? Like, when was the period of time, like in years, like 2000 and what?
Yeah, so we started building the product in 2000. We launched in 2001, early 2001. And so we kind of grew through the Australian market in 2001, 2002. And we're doing really well, right? So I think it was one of the things that made us globally successful, is we were able to get a really great dominant position in our kind of home market, if you like, compared to the UK, where it was super competitive and everyone was like, I'll get on that in a second. So early 2003, we were like, we'd raised our eyes to go, where do we go internationally? And our assumption back then, this is early 2003, was that the US market was going to be full of super well-funded competitors, which it was, but most of them died. And it was going to be so competitive that we should just leave it alone for now. So we decided to go after the UK market, which is big enough, like it's bigger than the Australian market, culturally similar, legal system way closer than the US market. Bunch of reasons why we thought the UK was the best place to go. So that's when I moved to the UK for 3 years, and we started growing there. But we also found, and this is kind of one of the big learnings we got, was when I landed in the UK, there were like 8 competitors that were all kind of fighting each other and bashing each other and giving each other bloody noses. And there was no clear winner, right? So none of them had got to the point of going, okay, let's go internationally, because they were just trying to win the domestic market. So from that, we learned the lesson that, we wanted to remain in the UK because it's such a kind of influential market when it comes to consultants and construction projects globally. So we stayed there and continued fighting these guys and kind of distracting them a little bit more. But then we went, okay, where do we need to go in the world where there were 3 things we look for? The market had to be big enough to care. So is the construction market big? Are they ready for it? Like, have they got, good enough, crazy back then, like, is their internet infrastructure good enough? All that kind of stuff. Are they ready for this? Because it was a shift. And then the third thing was, is the competitive landscape open? So on the back of that, we picked like Hong Kong and Macau was one, and then kind of Dubai in the Middle East was another. And we kind of put kind of resources and salespeople behind those 2 markets. And that was in late 2004, early 2005. And that kind of lit the match under the rocket of growth. Like, we were growing really strongly, like we were more than double, but that was like super growth through that period from 2005 to 2008 when the GFC happened. That was kind of super growth period. And then GFC happened. And again, that was a lucky thing for us. a lot of our competitors got really smacked around by the GFC. So if you're in the UK, for example, only in the UK, those competitors got really hurt because, the market really kind of contracted and they were exposed to that one market. If you were just in the Middle East and the Middle East had projects that just went bust, you would be really hurt by that. And we're exposed to both of those markets, but we're also exposed to not just high-rise residential and not just kind of, shopping centers and that kind of stuff, but we were exposed to mining projects and oil and gas projects, and and they have a kind of a counter-cyclical kind of element to them, right? When the world went into kind of the GFC, mining projects for the most part weren't affected. So all of that part of our business is fine. So our Australian business kind of sailed through the GFC quite well. And while our growth globally slowed, it never went backwards. We never shrunk. We never went negative growth. We just continued to grow, but at a slower rate. And then we came through the GFC as kind of clearly the dominant global player in the space. And then, as things pick back up, and I often say to people who have a business that goes through a really tough economic time, it's actually I always look for the silver lining. It can actually be a real opportunity, because if you can navigate the kind of the hard economic time and you come through the other side intact, then you're going to have learned a whole bunch of good lessons, by the way. Your competitors, for the most part, would have fallen away. So you're going to come through with a much more open, competitive landscape. And the growth comes back in. And so people can actually come through a bad time and come through the other side like really, really strongly. And that's kind of what happened to us too. And so, you can imagine the early 2010s as growth started picking back up. And then we went public. We listed on the stock exchange in Australia in 2014. Continued to grow. We acquired, a UK competitor. European competitor, which had a UK presence as well. We acquired a domestic competitor, and that kind of helped grow our growth as well. And all of that wouldn't have been possible. Well, it might have been possible. It would have been way harder if we weren't public. It was actually one of the really positive parts about being public is we then had the currency to be able to go out and raise some money to go and acquire a competitor, rather than going to them and doing like a share swap. And you're not public and they're not public, and it's kind of all very up in the air. But raising hard cash and then going and buying someone was way easier. And that continued to grow. And then, then Oracle came along. So that was kind of like the journey we had in terms of growth.
Yeah. I guess like at the time where you were experiencing this fast growth, there probably was not. I'm making an assumption here. I was not involved in the business world at that time. I was probably still in school. But I don't know what the digital landscape was, so to speak. But I know there's a lot more emphasis now on like digital marketing, how people are putting themselves like on social media or video, whatever else. How do you think that if you were building Aconex in this time, you would have like having those channels would have maybe, I don't want to say like improve the success or maybe change direction or given you more? Or do you think that it's still very much, and we can speak to construction specifically, do you think it's still very much like, the direct sales, handshakes, traditional kind of events, going to see people and digital is not super high on the list of priorities?
Yeah. Let's, maybe I'll talk about digital marketing in just a second, but the digital landscape when we started was almost unrecognizable. So while the internet existed,
MySpace,
there was MySpace. Google didn't exist when we started, like, for crying out loud. There was no AWS, so you couldn't spin up your SaaS product on a platform like AWS or Azure, right? None of them existed. So we had to build our own cloud infrastructure to host our own software on. Like, we knew we needed to be cloud, even though the word cloud didn't exist. We knew we needed to be browser only, and have the infrastructure for our customers to. So that was tough. Like
that would have been actually a pivotal decision. I think that would have had a big impact, right? Because I'm guessing a lot of, and still to this day, a lot of the legacy software are still not cloud based.
Yeah, totally. But we, right from the very start, we knew that we needed to be software that a project team was using, not just one company, but the whole project team. So by definition, we didn't want any software installed inside one company's firewall, because that wasn't how the project team, like if the software was hosted by the builder, say, then the clients and the architects weren't going to be willing to use it, because you're going to be storing my software and my data inside your company. Like, no thanks. So it needed to be independent. It needed to be neutral. It needed to be hosted in our independent net. It was called ASP back then, as application service provider, but it was effectively the cloud. So that was true. Also, the iPhone didn't exist for the first 7 years that we were around. So, there was certainly no Facebook or Instagram or digital marketing that kind of you could do in that sense. So that's all like since 2010, really, in terms of like digital marketing on phones. And while subcontractors use phones and I think they're also, I don't think that's how they buy, especially tools for their job. I think they're very picky, but they're very pragmatic. So I think software and construction, people will buy it and they'll spend money on it if it helps them solve a problem. And they're really firm on that. Like if it's just yet another software tool, that's just another thing they've got to use, and it's marginal whether it helps them a lot, they just don't get involved. And I think the most important thing you've got to do is you've got to solve a real problem, and you've got to articulate to the customer that you get their pain and that you can help them solve it. I think they're the two most important things. And if you can do that through digital marketing, great. But I don't think necessarily that's a channel in which they consume stuff for their business. It's a channel, but I don't think it's the channel. And yeah, I think, this kind of, especially when they're spending tens of thousands of dollars or hundreds of thousands of dollars, or even more recently, millions of dollars per annum, they don't do that through kind of online procurement.
Yeah, makes sense. Okay, where do we go with this? I've got a couple more topics I want to cover. One, because I think it's just a interesting story. Tell us about the short sellers and how that impacted the acquisition by Oracle.
Yeah, so being public for the most part, I think was a really positive thing for us. A lot of people kind of give the advice, don't be public if you don't need to be. It's like a pain in the ass. It's expensive. It's it's very short-term thinking, all that kind of stuff, and all that's kind of true. But we were behaving like a publicly listed company before we were public. Like we were reporting like we were public. We were, doing all those things as a public company would when we were private. So when we went public, I think there were the positives that came out of it. For several things. So one of them was, I suppose, internally for our team, while it wasn't an end goal and it certainly wasn't end of the road, it was a point of validation. They were like, oh my God, like what we've done here, we're now a public company. We're not just a private software company. There was this validation for them. It was certainly really positive for certain types of our customers, especially the bigger ones. The bigger ones were way more happy contracting big contracts with a publicly listed company than a private one. So I think that kind of just reduces another hurdle in the procurement process, especially with big customers. It made our employees who had ESOP, options, all of a sudden those options that were very kind of hand wavy and vague, all of a sudden they just had something real and tangible that they could kind of point to and go, they're worth a certain amount now. So I think that made kind of attracting really good talent easier. And then we also had the ability to raise chunks of money to go off and do acquisitions. So we did an acquisition of, I said, our kind of European competitor, and we raised the money we needed for that in 2 days. We went to the market. It helped that we were doing really well. Wow. So the market was, looking kindly on us, but we were able to raise that $100 million or euros. I can't remember which one it was, but, and we did that in 2 days. And then we went off and did this acquisition and brought them in, and it was a really successful acquisition. That all worked really well. The downside of it was the short sellers. So if people don't know what short sellers are kind of the opposite of when people buy stock. When people buy stock, they go to the stock market, they They give money, they get shares, and they hope the shares go up. And then if the shares go up, they sell them later and they get more money than they bought them for, and they make money and everyone's happy. Short sellers are betting that the market goes down. So what they do is, say the stock price is $10, they go in and they don't buy the stock at $10. They borrow, literally borrow shares off someone who already has shares, and go to them and say, hey, you got 100 shares at $10. I'll pay you, 50 cents per share just to borrow them off you for a year. And then what they do is they go and with these shares they've borrowed, and they then sell them. So they're selling something they've never bought, for one, which is kind of weird.
Yeah.
But then they sell them at $10. They get the $10 in their pocket, and then they hope that the price goes down. So they're trying to get the price down to like $2, because if the price goes down to $2, they can then go and buy the share at $2 and give it back to the person they borrowed it from. And what they've done is they've borrowed it, they've sold it for $10, the thing they never had. They've bought it at $2 and they've made $8 in between. So they need the price to go down. And because short sellers aren't regulated in most markets, they can go and spread rumors and tell stories and do all sorts of stuff to try and force the price down. And that's what happened to us. Like, we had, at one point, because we were doing really well with our share price, the short sellers went, oh, here's an opportunity. And then we were at one point the most shorted stock on the ASX. So nobody had more short sellers in them than we did. I think we had 20% of our stock was short sold. And then, they were spreading rumors and price went down. And that's when the downside is, that's when Oracle and another company that was looking at us started throwing offers in to buy us, because we went from being kind of a moderately like a good price to being cheap. And that's when they went, okay, here's our opportunity. We can go in and buy these guys cheap. Now, we didn't say yes to the first offer because we were cheap. We were like, no, go away, and they'll go away, and they kind of put in another offer, go away. And they kept on kind of upping their price a bit. And you can't say no forever, right? Like, you've got to, at some point, the offer gets into a zone that's where you've got to think about it a bit. It's not just a straight no, it's a well, maybe, and then it gets into a yes zone. So, and we had people advising us on this about, and they said, you got this zone where you can say get stuffed. Absolutely, that's a zone to get stuffed. There's a zone which is a bit grey, and then they said that if it gets above this, there's probably a zone where, as directors, you've got an obligation to engage and have the discussion and take it to your shareholders. So that's what happened. The price got to that point, and we took it to our shareholders, and the shareholders went, yeah, that sounds fine. And all of a sudden, bang, the company sold. It's one of the tragedies, I suppose, maybe it's a strong word, that one of Australia's most successful listed technology companies is now no longer listed on the ASX because of short sellers. So the only thing was good out of that story is the short sellers didn't know that Oracle was coming in to buy us, because you had to keep it very quiet until it's announced, because it's very you can't have rumors on the market. You've got to say it's absolutely happening, or you just stay quiet. And so the morning that it got announced, that morning that I had that kind of breakdown in the foyer, as soon as it was announced, the share price rocketed up to the acquisition price or just under it. And so all the short sellers got crunched in that, and they got burnt by the price going up, because they couldn't buy at that cheap price anymore, and they had to give their shares back. And when it got the next day on the AFR, which is the Australian Financial Review, the Australian financial paper, which is like the Financial Times in the UK, they had a big back page about it, and they had a call out. The text that kind of got blown up a little bit that said, I love this bit. It said, you could smell the burning flesh coming from the keyboards of the short sellers. Because they absolutely got burnt. They were just trying to sell and and it was just too late. So, yeah, nice. I have no sympathy for those guys at all.
Yeah, brilliant story. Love it. Let's spend the last 10 minutes or so, Rob, talking about how you as a founder of Aconex transitioned into like as fully fledged CEO, managing, I don't know, how many people were at Aconex at the exit time?
There were about 1,000.
Yeah.
And And so, by the way, Lee was the CEO at the exit time. I was running product and engineering.
Okay,
But
yeah.
yeah, we're a 1,000-person company at the end. So it was a big company, right? Like in terms of a software company that's getting up there, and they were kind of spread all around the world. Yeah, it was, yeah, it was quite something.
Yeah, how does your how did your mindset experience day to day change through that transition? And are you in positions now where you're advising people that are going through similar things where suddenly there's like them and maybe a team of 5, then they go up to like 20, 30, 40, 50, 100
Mm,
plus, 200 and
yeah,
so on. And how do you advise that people like manage this transition? Because it can be totally unrecognizable from like day one to day
yeah,
whatever.
yeah. Yeah, I often I've talked to founders about these various kind of maturity kind of points that you hit as a startup. And maybe I'll talk through. So when I kind of say it's easy, I often say it's easy to get to 1 to 3 mil ARR, but it's not easy at all, right? Like 99% of startups don't even get to that point. Most fail. But if you don't fail, then you kind of get to like 1, 2, 3 million ARR, right? Like, and you get there based on the sheer will of the founders and kind of founder-led sales and kind of just grunt. It gets you to like $1, 2, 3 million ARR. But to go from 3 to 10, you need to have a repeatable sales engine. Well, by that I mean you need to bring on other salespeople that start selling, and you need to be able to onboard them and give them all the tools they need to be able to sell, like objection handling and how to position it and all that kind of stuff. And so that's kind of like one maturity kind of step is going from like 3 mil to 10 mil ARR, and then going from 10 to 30, the next tripling. Kind of, you've got to have some maturity that kind of comes into the business, that you got to grow up in some ways, especially around how you build software. You can't be as cowboy anymore. Like in the early days, you could be, a bit cowboy, right? You get away with stuff that, when you got serious customers and lots of customers, you can't be that shoot from the hip anymore. And then going
Yeah.
from 30 to 100, and 30 to 100 is like when you get to 100 mil ARR, you're a serious software business if you're doing kind of repeatable ARR SaaS stuff,
Mm.
right? And when you get to 100 people, like that's so 10 mil is about 100 people, by the way. And once you go past 100 people, the things change both from a maturity and process point of view, but also there's plenty of studies outside software about this, that when social groups get beyond 100, it changes the dynamic, right? Like below 100 people, you know everyone's name. It's really quite intimate. It's very personal, right? And you go above 100 people, and all of a sudden you start going, "Oh, who's that guy?" And like you don't know everyone's name necessarily, or if you do know everyone's name, you don't know them as intimately as you did before, right? Like the kind of the social fabric is different, right? Like it goes from being almost like a village or a family to being something other than that, and that's a maturity that happens between as you go through the 100-person mark, and then. I remember going past that point and going past 100 people for one. And when you have people that is above 100, you start having to have more processes, because when you're below 100, you rely on everyone just doing the right thing, because everyone just knows. Everyone knows each other. Everyone knows what's going on. Everyone just knows. Whereas above 100 people, you need to have processes. And then you can over dial on that too, right? Like I remember when we went kind of through about the 200-person mark, we just went stupid crazy on processes, right? Like at the time you think it's the right thing. Oh, we're going to have a process for this and a process for that. But then we realized we'd overdone it when we had a process to define processes. It's like, okay, this is crazy. And so then you kind of wheel it back and you go back to being, to having processes, but being more pragmatic about it, right? So, but it's all part of those maturity like levels that you go through. Yeah, and I reckon going through 10 million is a pretty major one, a really major one, but then 30 and 100 are the next two kind of major steps.
Mm, mm. Yeah, nice. What are some of like do you notice recurring patterns? You mentioned earlier that like we had a joke about you being like 90% psychology. Was it 90% psychology, 10% execution, or whatever it was? Are there recurring things that come up with founders that you notice? Like, is it common things, or is it really everyone's problems are individual?
No, there's commonality for sure. Especially if you talk about the good ones, the ones who have that, they've got ego and confidence, but they're also got humility. If you talk about those people, then there's similarities in them for sure. And I love dealing with those people too, by the way, because they've got, just think about it. If you're trying to help someone out and they're both super capable, but also like, I want to learn, help me get better. There's such a malleable, fun, enjoyable thing to work with. There's someone who has that kind of mindset. So while everyone goes through the difficult phases and they have challenges, and the challenges, by the way, once they go past 100, they feel like they're losing control. They feel like they don't know everyone. They feel like it's not the same. Like everyone goes through that kind of $10 million one. But even in under the $100 million one, there's this under the 10 million, between 3 and 10. I think people struggle with delegation. That's probably the biggest, like in that period. That delegation is always a problem for a founder, right? Because you naturally want to do, but between 3 and 10, I think that's where delegation is hardest, because you have to delegate. You have to have a sales team that's beyond you, but and there's going to be salespeople you bring on that don't pitch as well as you, but you've got to be comfortable with that. You got to give them the tools to succeed as well as you possibly can, because if you don't do that, then you're guaranteed to be only ever as big as you can be as an individual. Yeah. So if I would say for the ones that are good, there's absolutely similarities in their journey, which is they think it's everything's kind of unique to them, but they're actually really, I think, happy when they kind of understand that they're not the only one and this is common. And I think that gives them a whole bunch of comfort, because it is tough. It's lonely and it's tough. And as you get bigger, there are kind of increasingly fewer people that have been in your shoes. So if they're talking to someone who's been in their shoes before, and they kind of get comfort that, everyone goes through the same challenge, then they can it gives them the confidence to go back and back up.
Yeah, that's totally normal. Okay, 2 quick fire questions so I can squeeze as much from this as possible. Number one. Okay, let's go to number 2 because I forgot what number 1 was. Number 2 was, tell us a little bit about your. I literally slipped my mind. Tell us a little bit about some of the portfolio companies at Gitch Capital that you're excited about.
Yeah, I can't. We actually haven't announced them formally yet.
Okay.
We've deployed 5, which is actually a lot considering we've only been formally launched since like February, March this year. We've already deployed 5. But we've got. I can talk about the kind of companies. Maybe that's the best way to talk about it. Not that they're secret squirrel. It's just that we haven't done the formal kind of announcement, and I don't want to preempt that. So there's like an ed tech business that works with universities. There's a company that does that helps software companies that build software, and they need to then do either test environments or demo environments, which is, anyone who's built software knows that spinning up those environments is actually a real pain in the ass, especially if you want to put good data in there, like data that's not just crap data that you can actually test with, but you don't want to put custom data in there, right? So it's a company that helps with that process. We've got a health tech business. All of these companies, by the way, have an AI angle to them, but importantly, they're not going, hey, let's build an AI company. What do we do? They're like, here's a problem we need to solve, and AI can help us solve it better.
Yeah. Nice.
Yeah, and I think you got to be problem first, technology second. Absolutely. If I was like building another startup, which I haven't said no to yet, like just not right now, given the things that are going on. The thing that AI does to companies right now is twofold. One is it helps you build software faster and better. It supercharges your engineering team to build software faster. But also then you can then have customer facing outcomes that weren't possible without AI. Just in the way that you engage, even user interfaces. Like before, you used to have to upload something and then put a whole bunch of data entry in. Like even simple examples where that stuff is just done for you. Like you can just do things that you could never do before with AI. Even the interesting thing too, by the way, is there's some tools that are coming out that are kind of agentic tools that sit above a platform. Importantly, they sit above platforms. So imagine, a tool like Aconex is actually a really powerful tool, but with power comes complexity, right? Like as a user, you're like, okay, if you're a first-time user, you're like, okay, maybe I can figure this out, but it's going to take me a while to kind of get to know all of the power of this thing. Whereas if you've got an agentic agent that you can go, you've got an account to Aconex, you've got to log on, and you can give it in kind of like natural language. Hey, here's 1,000 drawings. Can you process them for me, and then issue them to the right people, and then write me an RFI and pull some information from the accounting system, which is separate to Aconex, and pull that in, and it can go off and it can actually touch into different tools and make the user experience or the UX kind of less painful for people, because we all know that that's the balance when you're building great software is putting more and more capacity and capability into the software while making it easy to use and simple. Like they're kind of like they're always fighting against each other. But if you can make really powerful software and then have an interface that kind of circumvents all that complexity, I see there's going to be lots of power and benefit in that.
Very nice.
Mm.
Okay. Yeah, my number one question, I forgot, the very last one, and you can give us a quick answer as you like. If you were going to build in construction technology in our construction field again, maybe we can zoom out a little bit. We say if you were going to build again, because you mentioned it in your previous response, and if it was in construction, where would you build? What kind of technology would you think would excite you?
Yeah. Well, I mean, the technology is easy. Like it would have to be AI first in terms of it's not AI before the problem, but the technology would have to be very AI centric. But with especially great software companies, even outside construction, don't have to be sexy, right? They don't have to solve sexy problems. And inside construction, they certainly, for the most part, they aren't sexy. But I think there's a whole bunch of areas that kind of like that are obvious, right? And if you kind of go like what Aconex did really well around document control and communication, it's unsexy, but it's necessary, right? And I think what's happened with technology is you had tools like Aconex were the first disruptor that came along that kind of disrupted kind of the internal document EDMS tools, and where everyone had their own version of the truth and everything. And so we disrupted that and we kind of made it a cloud-based, everyone uses the same tool. And it made it kind of digitized an existing process. It made it more efficient, but you still had to do a whole lot of kind of human data entry to get the data into the system in the first place. And so I think a couple of things. I think the next wave of disruption is going to be tools where humans don't have to do all the data entry themselves because we're bad at it. We do it late. We do it wrong. We make mistakes. Tools where data entry is done by either consuming information, like sucking in, data from other tools, or sucking in documents and processing them, or taking imagery from the site and processing the imagery and making assumptions based on that. Using these engines to put the data into the tool themselves is the next wave. So, hopefully you don't have people in 5 years having to do data entry. So data entry is getting around that. So I think I can imagine, like, in fact, I've already imagined like how you would, without giving too much away, how you would totally reimagine the world of document control, right? Like it's, to me, there's a way of taking what, Aconex did, and that was great compared to what was there before. But there's a new world where you can kind of totally disrupt that with something that's, way more easy for people to use. The data entry is kind of not humans for the most part. Like 99% of it's not human centric. and then importantly, then humans are able to go off and do what they need to do. But then you're not using these tools as a record of what's happened or a tell me what has gone wrong, where they've got these tools that can then predict when something's going to go wrong. I think that's kind of the holy grail.
Yeah, interesting. Okay, Rob, thank you so much for joining me. Yeah, I hope you're enjoying your time in London. We picked a very good day to record remotely because since we hit record, it has been very, very dull, grey, and rainy. So, welcome.
Yeah. Well, it's been the last few days has been beautiful. It's been sunny and cold, but sunny and blue skies, which is a lovely place.
A good autumn weather. Cool. All right, Rob. Thank you.
All right. Thanks, Owen.